All right, guys, this is being recorded. And of course, like a broken record, one thing I say at the beginning of all these is watch it again, especially if this is the first time through with this type of strategy. There's going to be some nuances that I talk about that you aren't going to find online. Yeah, I know you can go out there and find out how to do a poor man's covered call, but they're not going to give you like exact strike locations. They're not going to give you rules to follow in order to be successful in this, because you can legitimately set this strategy up where you are in a lot of peril, where you can almost pay the width of a spread. Think about buying a call spread or something like that, a $10 wide call spread, and you're paying $10. Does anybody want to do that? You paid the width of the strike. All you have is the opportunity to lose that money. And this strategy is very similar to that same scenario I just gave you. So you have to make sure you follow these rules, especially a couple of them, in order to be to increase your probabilities of success. Okay, that's what we're worried about here. It's not a guarantee, but it will increase your probabilities of success. And I'll go through some examples of how you'll see that same situation I just talked about show up in many occasions. But having said that, watch it again relatively soon after so it sticks into your long-term memory. If you just watch it today and you go to do this strategy in a couple months, you're not probably going to remember all the little details. Anyway, a couple of things I got to get out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal. I've done commentary on everything from economic to geopolitical and market analysis. I've actually even done quite a few debates on CNBC with some people that you probably know. Anyway, I started out trading in college. I've been trading over 25 years now. Started out with a psychology degree, started playing around with stocks, options, things of that nature. Once I graduated from college, I moved straight to Chicago, started out as a runner on the floor of the board of trade, and ended up selling all my stocks, buying a badge. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and basically options on all these products in just about every market condition. Go over this disclaimer real quick. Please pause it if you're watching this on tape delay and read over it. And please take a moment to go over this. Basically, what this says is I am trying to give you guys ideas as to how to build option strategies. I'm not trying to give you investment advice. I'm trying to teach you different ways to trade. And you got to take that information and implement it into your portfolios in your own way. At the end of the day, I don't know what's in your portfolios. I don't know what's your risk parameters are. So how would it be right for me to tell you that a certain strategy on a particular underlying is appropriate for you? There's no way I can know that. And I completely wholeheartedly agree with that. So please take this, learn from it, and implement it in your own way. If you guys take my trades and implement them into your portfolios, you know you've done that on your own account. But please remember the past performance of any trading system or methodology is not necessarily indicative of future results. All right, this is how to create a poor man's covered call, you guys. And if you guys, everybody pretty much, when they get into investing, they start out with going out and buying stocks. And I have nothing bad to say about that. If that's what you like to do, collect those dividends, then I absolutely really have no qualms with that. I have pretty much switched completely out of using stocks, selling calls, which is what I started out doing in college, and let it get called away from me, implement some other strategies to get those back, and played around with that for a long time. But I didn't know how to build a poor man's covered call, which would have saved me a lot of money in margin, you guys, because back in the day when I was doing it with a discount brokerage, and depending on how you're set up with your brokerage, it cost a lot of money back in the day to go out and buy stocks and stuff like that, because I had to come up with the full boat for it. So if I bought 100 stocks of IBM at $100, you know, that's a $10,000 bill, right? I mean, and with options, that would be like $2,500 for the same type of what's the word I'm looking for? directionality and the amount of money you would make on that move. I'm sorry, I'm a loss for words right there. But the bottom line is I would have been able to build a much better hedged portfolio had I had this in mind and been able to buy more stocks in a sense. So I'm diversifying my portfolio by doing it this way. And that goes for anybody. If you have a book of stocks, think about it, you could have almost twice as many stocks in that same portfolio because with options you can use more leverage. All right, and we'll talk about some other benefits here in a minute. Something else you can do is follow me on Twitter at Wolfman's blog, and you can follow our parent company at ProTraderStrat. I usually tweet out stuff about trades that I'm doing during earnings because I give daily market commentaries. I don't know exactly strike location, things of that nature to tell you guys what I'm doing early in the morning because I put those on late in the afternoon. So I usually will tweet those out for you guys. I'm not necessarily going to give the exact strike location because after watching these webinars, you guys should know exactly where I'm going. I go to the same place every time. And stay mechanical with it. All right. So this, like I mentioned, is the poor man's covered call. Couple of things to know about the poor man's covered call is it is a diagonal spread. It's a very long diagonal spread. And it's basically covered calls on leaps. Now, something about the leaps. I don't like to go out to a real leap, which is a long-term anticipation or anticipation security. That's the AP. So I don't like to go that far out, but I do like to go out somewhere between 90, about 150 days to expiration is right around the wheelhouse. 90 days would be on the shallow side of implementing this, but I like to try and shoot for somewhere around 150. And what that has the tendency to give you the best return on capital and makes this strategy work out pretty close to being the best. So somewhere around 150, maybe a little bit more too, but on the lean end, on the closest to expiration would be 90. I wouldn't go much further inside of that for various reasons that I'll talk about here in a minute. And then the one that we're covering that long-term option with is about 35 days to expiration. So if you've watched a few of these other ones, right, a few of my other webinars, when we're selling options, what do we like to do? We like to get closer to expiration. That 35, 45 days to expiration is the perfect wheelhouse. Or no, I can't say perfect. You can't say perfect on anything. But is the what I've found to be the best time to start selling options because you get the theta decay happening and then that offsets your theta decay in that long option expiration because the one that's near is going to decay much quicker. Okay, so we want to get somewhere with that covered call inside of 35 days. It's not a calendar spread, you guys. I've heard it called the calendar spread before, but that is incorrect. The calendar spread is going to be the same strikes. We're not picking the same strikes here. We're going to pick one that's in the money, that long duration one, and then we're going to be selling one against it in the near term. And that one that we're selling against it, we've talked about this also before, you guys. Every option has intrinsic and extrinsic value. What we're trying to do by selling that option in the near term, what do I got up here? FedEx. It doesn't matter. But what I'm trying to do here is use this out of the money call to pay for the extrinsic value of an in the money call. So like right over here, you can look at it. This is a floor trader hack, you guys. You know, we can figure out intrinsic and extrinsic value, right? The value of the 195 strike for FedEx is really worth probably right around $50, okay? I'm rounding up by about 50 cents, but it's $50. So actually, it's probably a little more than that. It's 44 and 5, so yeah, $50. So there's probably close to $3.50 in extrinsic value or $3 in extrinsic value. One of the floor trader hacks was we can figure out the exact amount by doing that math. What this strike is minus where it's trading, and that is what the extrinsic value is, okay? One floor trader hack is to just kind of glance over here at the opposing puts, if you're looking at in the money calls, and that should give you a very close rough estimation of what the extrinsic value of this option is. So rather than doing the math all the time, that's what I do, floor trader hack. That was one of the things on the floor. You have to come up with these quick ways to do math in order to get the fastest quote out there. The person with the first quote was usually the one that got the order. So you had to be quick. So these are little hacks that we would use on the floor. If I looked at this, okay, I want to pay for the extrinsic value of this. So I look up here and try and find that strike that closely resembles that. You can see that it's not going to do that in this particular situation. But that's the idea, is we want to pay for the extrinsic value of the option we're buying in that long duration expiration cycle. Does that make sense for everybody? We're trying to pay for the extrinsic value of this stock by selling a near duration. Now, if you can't do it in the first month, you might have to let this one go out worthless or for a couple of pennies and then roll this out in time to like the June. Now, hopefully this market's kind of gone up close to the strike and then we roll it out and up. So we would be able to roll out in time to the June and maybe up to the 270 strike to collect another $1 or so, okay? And the idea is to continue to lower basis, just like you would do with a covered call strategy where you bought the stock, you're selling calls against that to lower how much you paid for it. And that is how you increase yield, your return, okay? If I paid less for this stock, I've increased my return, and you constantly do that. So you're selling calls and you're trying to roll them out in time and up in a way. You know, if I'll go into the other part I was just going to say in a little bit. One thing is to note, this is a bullish strategy, but slightly. Like, we don't want this to happen in the next couple of days, right? Because all that's going to happen to our near duration option is go up in value. We want that theta decay to really kind of decay. So the idea is we're not like wildly bullish about this, like, necessarily a takeover or something like that. Maybe down the road after we've sold a couple of calls against it and we've paid for that extrinsic value and things of that nature, then yeah, sure. Then it's kind of free money at that point, right? But right now, we don't want that the first week or so after we've set this up. We want that theta decay in that front month to pay for our extrinsic value of that long duration option. All right, so why use options in place of stocks? I've kind of gone over this because I got a little bit ahead of myself and I like to talk, but let's just go over them again. We're reducing our risk. How are we reducing our risk? Well, remember I talked about that in the money option? Well, it's got a synthetic put in it. In that, because we're going to be starting out around an 80 delta call option, really anything below that 80, if it trades below that 80 delta option that we picked, we have no more risk, right? It's going to have hurt. I'm not going to lie there, but we don't have any more risk to the downside. So rather than a covered call, just a stock with a covered call, this has reduced risk in that it's got an embedded synthetic put in it. Remember what I was talking about for some of the newer, I know some of the guys that are been on a lot of my webinars will be aware of this, but think about it. When you're buying the call, you have the right, but not the obligation to take this stock, right? So if the call goes, or the underlying goes below 195 and it's trading at 194.99, that means I have no more risk to the downside. Actually, you could almost say that once it's trading 195 even, you have no more risk because I have no risk below this. All right, so there's a synthetic put embedded in there, which reduces our risk as opposed to just a covered call strategy. All right. Reduce capital requirements. I mentioned this. If you go out and buy a stock, yes, you can buy stock on leverage. I'm aware of that, but a lot of people that buy stock on for a portfolio over the long duration will pay for the full amount of that stock. With this, we're going to be paying about 25% of what it would cost to go out and buy a stock. You know, $100 stock, 100 times $10,000. This will cost you about $2,500 in a margin account. I'm not really sure. Shouldn't cost any more in an IRA either. But you're going to have reduced capital requirements for it. All right. You're also going to be able to create a more diversified portfolio of securities. I mentioned this. If you're paying less for 100 of XYZ stock with options, obviously you can buy more or other stocks in order to diversify that portfolio. Remember what I was talking about when I was in college? I only had like 4 or 5 stocks. I had IBM and Walmart were 2 of the major ones, and that's the ones I always sold the covered calls against. I can't even really remember what the other ones were. But at the end of the day, I would have been able to have a lot. I probably would have had twice as many stocks in my portfolio had I just been trading with the covered call strategy. And probably would have saved myself some money too, to be quite honest. All right. Also, it has a higher probability of success. Part of that has to do with that reduced risk. Our probabilities of success with this one are going to be much higher. And then our return on capital is going to be higher as well. Remember, if we're paying $2,500 for that same strategy I talked about versus $100,000, when we make the same amount of money on the gains, but we use less money to get there, that means the capital we put out there has a higher return than what the other side would have had, okay? Is the in-the-money call similar to a married put with stock? Yes, it is. Except we're not paying for this put necessarily. All right. All right, the disadvantages of it's a disadvantage of a poor man's covered call versus other option strategies, you guys, is what this is really coming down to. It's not having to correlate towards another stock in this particular instance. Must stay active during option cycles with earnings. We're coming into earnings season. If we're setting this strategy up now, we're going to have to deal with earnings. And the same thing you would have to deal with earnings when you're doing a stock, right? If you buy a stock, you have to deal with earnings. You have to deal with those ebbs and flows. So no getting into this strategy because we're buying 150 to, plus days out in time, there's going to be at least an option underlying earnings. If you do ETFs, you don't necessarily have to worry about that. But this is with talking strictly with stock to stock, trying to compare apples to apples in a sense. So you are going to have to stay active in earning cycles. You can cover it if you're at a profit. I don't have a problem with that. But what I'm just saying is because you're going to have an options or you're going to have an earnings inside of that options expiration, just to know. All right, long calls eventually will expire. That means that long duration option is going to eventually expire and you are going to be left with nothing, right? Whereas stock you can carry for 10, 12 years, all right? That's not how I trade. I trade for the shorter duration. And, usually when you're trading options, you kind of start moving from that long time frame outlook to a more narrowed outlook. And even when I used to start doing this with the poor man's covered call, I was buying those 300 days out, and I've slowly started marching that back in. Found about the 150 days to expiration is about the best because that, or 150, 160, because that kind of puts that front month that we're selling right around 35 days as well. So that all kind of starts correlating pretty nicely together. But we will have that option expire. Forced assignment on that short call. If it goes into the money, we could have forced assignment. Now, it's just, it's just a pain. Obviously, if you were long the stock and you had forced assignment, then, that would suck too, right? But what we've done here is we've achieved our goal. When we're picking that short call, it's kind of like I'm saying that's where, if it gets there, that's where I'd sell it, right? If somebody came up to you and you had a Snickers bar and they came up and said, hey, I'll give you $1 for it. Well, no. All right, I'll give you $5 for it. I'll probably sell a Snickers bar for $5, right? Because it's worth a lot more than what I expected. If we're selling that call, up at a 16 delta, and somebody wants to force us on that assignment, fine. We have that long put. We can just force assignment there as well, because it's going to be in the money at that point, or it's going to be in the money at that point. All right. So it's going to cost a little more to have that happen, but you have to be aware that if our goal, and we've made that happen, we're probably going to have to worry about that forced assignment, especially inside of like 10 days to expiration on that short call. If it's 30 days to expiration on that short call, you're probably not going to have to worry about the assignment. Most people kind of start thinking about that inside of 20 days, and or if there's a dividend. Some people might want to force that assignment so they can get the dividend, things of that nature too. So you do have to worry about that. At the end of the day, if that call goes into the money, I'm probably going to cover this strategy right away and just get out, because I've already achieved that goal. I've got my max profit. I've gotten the whole width of the spread. All right. So just cover it. Retool and die. You can go out there and set up another poor man's covered call if you're still loving the stock to the upside. But I'd cover that strategy and move on. The other thing you could do is roll that short call out in time and up. But it's probably better off just to close the strategy out. So poor man's covered call is a long call plus a short call. Yes, with two completely different expiration cycles. Okay, the long call is way out in time, and that's kind of acting like our married put stock, right? And then trying to sell short calls against it in order to take advantage of some theta decay. You're not going to receive a dividend with this. If you love dividends, you probably aren't going to love this strategy, but you aren't going to receive that dividend. But to me, if I had to pay, half or a quarter of what it would be to get the stock in order to get that dividend, and now I have 4 completely separate stocks with poor man covered calls versus just one stock with a covered call strategy, I think I'll take that, right? Because now I've increased my probabilities of success by being diversified across the board, right? It's not all eggs in one basket. So I think I would give up the dividend in order to be able to add more diversification to my portfolio, or more hedges, or even just any other trade, right? Okay. Couple of things. Rule of thumb: 6 months to 1 year out for the long call. Now, like I mentioned, my wheelhouse is right there at around the 150 days. That's what I like to be at for the expiration. The other thing is, when you're at about that 150 days out, makes it a little easier to pay for all of that extrinsic value by selling it in the first cycle. So meaning I don't have to roll that call in order to pay for extrinsic value, which you will sometimes. As a matter of fact, in that example that not an example, but when I had up my platform here, I think it was on FedEx. Yeah, you can see that if I have $3 in extrinsic value in this option, if I were to sell this option, I didn't pay for all that extrinsic value. I paid for about half of it. So I would expect that I would need to roll out in time and sell another one in order to pay for all of that extrinsic value. So when you get further out, you start seeing that this isn't 150. The SEP is right around 150, and not all stocks have that September contract right now. But that 150 usually will allow it to be very close in order to pay for all our extrinsic value, right? Some people do like to go out 1.5 to 2 years on these long calls to minimize that theta decay. You can do that. I don't have a problem with going further out in time. If you like that longer duration aspect, you can do that. Just know that it's going to be a situation similar to this, where you're going to have to roll that call a few times in order to pay for all that extrinsic value, which is what you want to do. All right. Baidu or Banu, we will be sending out a recording as soon as I get it done and kind of compressed and sent out. So yeah, anybody who is late, I see a lot of people are showing up a little bit later, so it is being recorded. and we'll send it out as soon as possible, as soon as I can get it done. All right, mention this maybe 1 or 2 times. Don't pay a lot of extrinsic value on that long call that we're way out there because we're selling some calls against it. But all right, here's some rules of thumb that I don't have on a slide because I didn't want to bore you with it, but you might want to write it down or write it down when you watch it over again. But when we're buying this in the money call, we're going to be buying it around an 80 delta, and usually that's where I start, at around an 80 delta, because that's where I would really like to be. It doesn't usually happen. I usually have to go to about an 84 or an 86 delta, but when we're talking about a starting point, best case scenario would be I could buy the 80 delta. It's usually going to end up being right around an 86 delta, I'll tell you. And then we're going to sell about a half standard deviation, or a 32, somewhere between a 32 and a 20 delta. So when we're in the money, we want to move closer to at the money, and we're out of the money, we want to move away from at the money. But that's our starting point, an 80 in the money delta with around a 30 out of the money call delta, and try and start there. Usually you're going to have to be right around there, but if you can move that short call out to maybe a 20 delta and the in the money down to like an 86 delta, then that's what we're looking for. In order to achieve this, and when I'm talking about that jockeying back and forth to figure out the right strikes, is to figure one, paying for the extrinsic value and moving those around, getting that down. Another thing that's very important with this strategy, what we're trying to shoot for on our debit is we want to pay less than 75% the width of the strikes. Okay, that is a green light. That's like, it's really hard to pass up if you are paying less than 75% the width of the strikes. Okay, that's a green light strategy. You're going for it. A yellow light strategy is somewhere between 75 and 85% the width of the strikes. That's kind of a yellow light. You got to really be like pretty sure about this strategy in order to implement it. And if you're paying greater than 85% the width of the strikes, then that's a red light. So when I'm saying that, like on a $10 wide, say I bought like the long duration 50 calls, okay, 150 days to expiration. I bought the 50 calls. Now I sell the 60 calls in the May, May. I think May is the 35 days. So then we're selling the May, right? Let's say if my total strategy cost me $8.90. Well, that's almost 90% the width of the strikes. I can lose $9 to make $1. That doesn't work, right? Your risk reward needs to be a little bit better. Yes, you will have a high probability of success with that. It's going to probably happen too fast for anyone's liking when it's that tight. We want to shoot for 75%, which is right around $7.50 for every $10 wide spread. Okay. And when I pull up the trading platform, we'll get into more details with that. So I like to touch on it. And then when we get in there and start working, you kind of have ideas where we're going. And I think it'll help it sink in a little bit better. And use lower volatility stocks. This isn't the implied volatility that I normally talk about. What I'm talking about here is lower volatility stocks, meaning like utilities. Not like the tech stocks where they're going to be bouncing all around. We don't want to feel that kind of volatility in there. We want those boring stocks. Walmart's a boring stock. I mean, the last couple of months it wasn't, but back in the day, Walmart and IBM were probably a couple of the most boring stocks there were. And that's what we want for this type of strategy. So we can just sell calls against it all the time. All right. Lower beta, yes, that's another way to say it. Lower beta stocks, absolutely, absolutely. I didn't want to lose a lot of people. I did think about saying that, but yeah, stocks that have lower beta or just are less volatile than others for some of the newer people. All right, so some of the people that aren't intermediate. I don't even know how you would enunciate the word that I had spelled before the webinar started. But anyway, an inside joke to some of the people that were early, right? All right, so sell the near term out of the money strike. That is the theta decay I always show. This is what we want, right? We want theta decay here, and where we're buying the stock, it's going to even flatten out further when we get outside of 150 days. This is going to continue to flatten out. So we want that slow theta decay in the one we bought, and we want the rapid theta decay in the one we sell, right? Get in and out of that quickly. So also make sure there's not a big difference in Vega between the months. Now, generally speaking, you guys, especially like last year, let's talk about last year, volatility in the longer duration months was higher than where we are currently at, all right? And that's called contango. And here's, you always hear about contango and backwardation, and first thing everybody's head does is explode, right? Well, I've got a floor trader hack or a trading hack for you. Backwardation means backward down, okay? So when they're talking about futures, there's backwardations. Basically what they're saying is that longer future is trading below where the near future is trading, okay? Backward down. Contango, just remember it's the opposite, it's up, okay? So usually volatility is higher in the longer duration in contango. Right now we're seeing a lot of them be backward sorry, I said that wrong. The generally speaking, stocks trade with contango where the volatility is higher out on the time horizon, and it is lower right now, which is in backwardation, which is means that the strike that the call we're selling has higher volatility than when we're buying. So that's going to help us out even more, because think about it, when we're selling higher volatility, we're collecting more credit for that. And when we're buying lower volatility, that's better, because that's what we want to pay. We want to buy low volatility. We want to buy cheap volatility. We want to sell expensive volatility. So right now we're seeing a lot of stocks have lower volatility out on the time horizon than what we normally would see, which is good for this strategy. Okay. All right. So max profit with the strikes minus the net debit paid. Okay. So I kind of gave you that thing where we're looking for our max profit to be somewhere around $2.50 or more on a $10 wide, right? Because I said we're looking to pay less than $7.50 for a $10 wide spread. That's the debit paid, $7.50 minus the width of the strikes is $10. Our max profit, it would be in that $2.50. And because there's unlimited, there could be considered unlimited profitability due to that front month expiring worthless, and then now you have all upside. So it could be considered, unlimited profitability. Max loss is that debit you paid. Anytime you pay a debit, that's your max loss. You don't have to worry about it. Just like with a stock, you pay for a stock 100% of it, your max loss is whatever you paid for it. Anyway, break even, the long call price plus the debit paid is our break even. And that's why we're trying to pay off all the extrinsic value, which means that long call strike plus what the intrinsic value would be right where the underlying is trading now would be a perfect scenario. Yeah, take that long call strike plus that debit paid. Hopefully that is right around where the underlying is trading currently. All right. And obviously volatility can affect the break even with it fluctuating, going up and down. So there's different months here. So the break even is kind of a ballpark figure, to be quite honest. All right. All right. I got a bunch of questions coming up. Let me try and grab a couple of these. Can you put a number on the Vega difference? Yes, I will. And I thought I actually had a slide for that. Where did I do the Vega difference? So where did I have my Vega difference? So the Vega difference between months. Now, generally, when we're talking about contango, where the back month is higher than where we currently are, and that's generally what you're going to see. This is where the rule applies. Because if it's in backwardation, you're going to probably, you don't need a green light for that. You don't need a red light. It's a green light because you're selling high volatility and buying cheap. All right, so this is when it's in contango, where volatility in the back month is higher than where the current month is. We want that to be somewhere between 5% and 10% differences, and they're pretty close generally speaking. Let's see if that FedEx was probably in. So this is what I was talking about. This is contango. 24 in the front, way back there, it's higher. That's contango. But a green light is when we're looking at this volatility numbers over here. This is 24.3. This is 26.06. So the difference is 2. Anything less than 10% is good. Anything less than 10% is good. 10% to 20% is a yellow light, and anything greater than a 20% difference here, don't even bother. You're paying way too much back here than you are up here, okay? And you will see that happen in medical stocks a lot, where there's nothing going on, but somebody knows there's a trial result coming up, and they're pumping up the premiums for that. Right, so the debit paid, and we talked about that. So let's actually pull this up. One thing I didn't mention on this particular webinar, my rules still are going to apply, you guys, when we're talking about we need a tight bid offer, okay? So some of the other strategies I'm talking about, when we're talking about picking the right underlying for this, you don't want to do this with just every single stock, because we want high volumes going on here, high open interest, because if there's high open interest here in these front months, then there's going to be some open interest in these back months. There's going to be people looking at them. So my rule of thumb is, if we're looking at a stock that is, let's say, $40, any stock under $100, we look at these bid asks, and it's got to be inside of 10 cents from the bid to the ask, okay? So this is 3 cents wide to the bid to the ask. Anything less than 10 cents on a stock under $100, something like what we had up there just a minute ago, which I probably can't find again, but was FedEx. Let's just go with the same example again. So FedEx is a stock. What is FedEx? FDX. So FedEx, it's a $200 stock. So it's stock over $100. Here's what you do. Take the decimal place, move it 3 ticks to the left. So 24 cents wide to the bid ask. And as you can see, FedEx fits that rule as well. So you don't want to get wider than that rule. Something even like Amazon, it's a $1,000 stock. Move decimal 3 ticks to the left, it's $1 wide. So the dollar for Amazon, and you will find that rule follows with Amazon and stuff like that. All right. Lee, I think I answered your question, right? Could you sell weeklies against the long options? Every Friday will be payday. You absolutely can. You absolutely can, especially if there's a lot of volume and open interest in these full months. Then yes, you can go to the nearer duration expiration cycles and play with the weeklies and collect some. Okay. All right, so let's go through a couple examples, because I kind of got long-winded early on. So I usually tell everybody, hey, throw me out a bunch of stuff, but I don't. Would this work for SPY or ETFs? Absolutely, Kat, it will. And I may have a couple examples for ETFs that I was going to use. I'll try and find one. I didn't, sorry, to vet them. But it's not going to work on every single stock, you guys. I mean, I had to go through my whole list of stock basically, and I probably came up with close to 12 or 13 out of about 50 stocks going right now that this will work with. I also want to make sure you guys understand, we probably don't want to be, since we're getting into earnings cycle, we probably don't want that earnings release inside of where these 2 months are. We probably want that earnings outside of even this next month, so we would have the opportunity to roll, especially with this one. That would have been one of those where it would work out. We buy that longer duration, we have a chance to roll it twice and maybe pay off all the extrinsic value, okay? But we don't want it to really have our short call land in a place where there is an earnings cycle like this. You're buying way out here, but you're selling that call that's going to have to go through the earnings. You're not going to get theta decay because volatility is going to hold that off. It's going to hold off any type of value loss in those options contracts. You'll see a little bit, but you're not going to see what you want to see. Let me put it that way. So we kind of want to skip out of that as well. Some of my examples may have one of those in there, but just know that if you're implementing this in the real world, try and avoid that at least for the first roll. And then if this, let's say for instance, this was clean and the option cycle or the earnings came out right here, I probably wouldn't sell a call in this options expiration. I would just let that long call ride through the earnings. Okay, so does that make sense to everybody? I'd try and skip this month. If it landed here, I'd collect it one time, hopefully pay off all my extrinsic value, and then ride it out through this and then start selling calls against it over in here. Okay, I can do, I think I looked at JP Morgan earlier today. I'll try it. We'll see what it looks like. Because I know they just had earnings. All right, so, whoops, we do that. Let's look at a chart. They just had earnings. We don't have to worry about that for quite some time. All right, so let's look at the strategy. It's a $100 stock, so we move it 3 ticks to the left, 10 cents wide. That fits that rule. When you're doing this rule, look at around the 30-some days to expiration. These will also when they're very close usually. But the ones I usually look at are the ones that are around 35 days. I'm not going to keep that rule 160 days out. It's just not going to happen usually, okay? This just so happens it does. But generally speaking, it won't. And another reason why we want that really tight bid ask, having a lot of volume and open interest means there's a lot of eyeballs on there. And if these out of the money ones that are close to where the underlying's trading are really wide, these ones that you're trying to buy here are going to be super wide. As you can see, these are 4 cents wide here, but we get into the money at the ones that I was talking about buying, and we're going to have to talk about, 75 cents and sometimes, $1 wide once you start getting deeper into the money, okay? All right, so first thing we do, that fits the rule. It's the right underlying, all right? We're in backwardation, which means we don't have to worry about a green light. That is a definite green light. Anytime this volatility is higher than that, automatic green light, okay? So that works. So let's start out with like right around the 80, it looks like, because see, I'm cheating already. I'm looking across at the extrinsic value, so I'm guessing that that's right around, I got to get around $1.30 something to pay for this one. So I pulled that one up, and then $1.30 is going to be right here, which is, it's still $5 away. So let's just take a look at it. So I've got $25. The width of this spread is $25, right? So I can already tell you, people are probably faster than me right now trying to pull up a calculator and did this math in their head. But what you do is you take what the underlying's trading at, 7.7, divided by the width of the spread. It's 25, so it's 83% the width of the spread. What did we say that was? That's a pretty dark yellow light, right? So, if I really loved it, I might move it to a possible list. But, to give you an example of one that kind of will fit it, just while we're talking about it, and by no means am I bullish on anybody who makes a cereal right now. Seems like millennials do not like cereal. So doesn't look like they have earnings anytime soon. They may very well. This doesn't always show them on this platform. So I'm going to start looking at the 80 delta here. We can start with, and the 80 delta. Is that right? No. Yeah, about the 80 delta. So I'm cheating by looking at these and seeing where I need, I want to sell probably the 67.5 calls or something like that. So I'm kind of cheating. I'm looking at these and saying, okay, that's all extrinsic value. An out of the money option has no intrinsic value, so I don't have to worry about that. So 50 cents, I'm kind of like looking over here and going, okay, well, I can pay for it if I go a little bit further away. And that's what I was talking about. I started out saying you're going to start out with the 80 and the 37. Well, that's pretty close. That's a little too close for me for wanting to do that. I want to get a little bit wider. But let's just look at it for happenstance because that's what I started out with. So we've got a $10 wide and it's $7.78. So that fits the rule, but I'm thinking I kind of want to go a little bit further. So I'm going to go a little bit further away because I want a little bit more room, wiggle room to the upside. So that's pretty close. So, oops, I held, let me delete all that. So going with the 50 and then selling the 67.5. So I guess we didn't buy the 50s yet. Buy the 50s, sell the 67.5s, and we've got how wide is that spread? 1750. So we've paid $12.19. I'm just going to round it up so I don't have to type a bunch of stuff. Divided by 1750, $17.50. So 74%. So that one, to me, is a little bit better because I got a little bit more wiggle room to the upside. I can make a little bit more money there for that risk I'm taking on. And remember, once it goes below that 50, once it goes below the 50s here, I have no risk to the downside because I'm not obligated to do anything with this strike. And this one's going to expire worthless. Now, what happens in the next month when all of a sudden I put this strategy on and it starts going down, right? It's looking like I'm losing money. Well, this option is going to expire worthless. And you can continue to sell calls against it and collect some more premium. Then you could go to those weeklies or something like that, start selling some calls against it. They might even have to be lower than the 67.5. Just make sure that you keep track of the total amount that you've paid, because you wouldn't want to do this strategy and the next month go in and sell the 60 calls or something like that, and now I've actually paid more than the width of the spread, right? Make sure that what you've paid is less than the width of the spread, always, even when rolling, okay? Try and stay away from, I'd almost rather not roll and lock myself into a loss than I'd rather not roll at all. Just let it expire, not roll into a loss, okay? Because then I have unlimited upside with that long call. So I just would stay away from that. And I see a couple questions coming up real quick, so let me try and nail those. So if it starts going against you, continue to sell those calls. You're just lowering your basis on it. And then if it starts coming back up when you're rolling out and away, okay? And just constantly keep jiggering back and forth. At some cases, you can pay that put off and be riding it for free. I've done that before. If you've watched the daily market commentaries when I've talked about those, I've rolled a poor man's covered call out so many times that I was literally riding it for free the whole time. And I talk about every trade I put on in these daily market commentaries too. In case the market tanks and the in-the-money call approaches the 50 delta, do we sell the option and readjust to the 80 delta? When the in-the-money call approaches the 50 delta, do we? No, I'm going to probably, you could, if it was basically right there, you could try and take as much money as you could, but at that point, it's going to be very close to all extrinsic value, and hopefully you paid for it already. And you can use your Fibonacci lines and stuff like that for this type of trade, where you're like, okay, if it gets below this, I don't have any problem with that either. Like, okay, so with FedEx, it's got a sharp, I mean, we could all say that, this is a pretty good support resistance level. You can even throw up your Fibonacci numbers if you have your Fibonacci's ready, and some reason, I don't know why it won't click for me. But anyway, you could throw your Fibonacci's on. Obviously not a very good one here, but maybe. You could say, okay, if it goes below this 23 Fibonacci, I'm out. And that might be very well what I would do with this one. If I expected this to bounce, I trade with market profile, I would expect FedEx to, or sorry, Special K to move higher if I was bullish and come back towards somewhere in this area, because that's where people have found value. That can all change with, millennials never buying cereal again. But, you can even say that if it gets below this, I'm out, not taking that risk anymore. And do that with your guys's, if you guys are very into trading around Fibonacci, market profile, support resistance lines, simple moving average, MACD, whatever it is, all of those things, you start seeing that, then implement that as well here, just like you would with a stock. Mervin says, I don't think this will work in a bear market. Well, if the stock is in a bear market, then I wouldn't do this. You're kind of catching knives, right? But there's always a bullish stock out there, even in a bear market, right? Because people have to put their money somewhere. So it, just like buying a stock in a bear market, it's not always fun either, right? So yes, anytime the market goes down and we're long stock, we're not liking it. You're not going to like being long a stock and it's going down in this either. So if you were bearish or wanted to implement this as a short, a poor man's covered put, stay tuned for next week, because that's what we're going to be talking about. So you can always kind of do it with something. Do you ever buy back the short? Do you ever buy the short back for 10 cents or so and then sell another one in the next expiration? Absolutely, Lee. I absolutely would. I'd keep rolling that out. I'm not going to try. I never try and collect every nickel of any option. That's one thing I do not do. And don't write anything out into expiration usually. So especially on the short end. So absolutely. As soon as I think I can roll it out and up, then I absolutely would. And I might even do it for, if I collected $1 for that short call and it was at 50 cents, but I was like, all right, well, this market looks like it's ready to pop. I need to roll out and up, collect some more premium, then absolutely. All of that stuff is part of the trading. And there's no real rule of thumb for me to give you on that, because there's so many different variables. But absolutely, if you have the idea where this could actually start to pop, I've gotten 50% of the premium I collected. You roll out in time, basically whatever that premium is you collected, you can add it in. 74% again. Yeah, what it means. Yes, absolutely. Give me 1 second. Make sure I kind of, why couldn't you just turn it on its head and put, you can, Kat. We're going to talk about that next week. And it has some different advantages as well. More advantages than the poor man's covered call. All right, so 74% again, real quick. So here, let me come up with a new one to look at. Let's just look at applied materials. This is one I vetted, so I know it's gonna work. A lot of them, like you guys can look at them later, and they don't work. There was one, and I didn't even write down some of the bad ones. But like XOP, I figured it out. It was like 82% with the strikes, but this one was pretty good. So applied material, I don't believe they have. It's coming at the very end there. So we're going to get a lot of theta decay within that time, and I'd probably cover it right in here. I'm going to have a time stop on getting out of this short call somewhere right in here, because I don't want that theta or that that earnings to come out really good and blast through it. You know, I don't want to take that risk. If I'm going to be taking risk into that, I'm just going to ride it out most likely. I don't want to limit to my upside on that situation. All right, so I'd try and cover these early, and I think I'd have the opportunity. So what do? We started around the 80 delta-ish, so we're going to be kind of trying to look at around these 45s. And if we do the 45s, I got to collect the $1.60, so I'm not going to be able to do that here, right? That $1.60 there. So I'm going to look at the 40s, which is pretty deep, but I'm going to go for it. It's a little bit deeper than I would normally want to go, but there's not a whole lot of strikes there, so I'm going to have to go with it. Plus the premium I want to get a little bit wider there. So that means I can probably do it with the 62.5s, right? Just doing the the floor trader hack with figuring out how much extrinsic value. There's 85 cents. Where can I get close to 85 cents? That's it. I don't care about 10 cents here or there, right, necessarily. So here's the thing with the 75%. Anything less than 75, anything where we can pay less than 75% the width of these strikes, that's a green light. If you're paying 75 to 85% the width of these strikes, then that's a yellow light. If you're paying anything above 85%, I would just walk away. So let me pull up my calculator again. Come up with taking the $16.20. So we've got $16.20. Whoops. 16.20. And divide that by the width of the spreads, or the width of this spread, which is 22.50. So divide that by 22.50 and 72%. So if I'm paying $16.20, it's 72% the width of the strike. So that's a green light, right? So I'll just show you one that would be like a yellow light right off the bat. And you will see it happen. I'm showing you all perfect examples. So there are examples where it won't work. XOP is going to be more of a yellow light, I believe. XOP, come on. All right, so XOP, we're looking at the May and the September. So XOP, let's just look at the 31 puts because I already looked at it. So the 31 puts are right here. I'm going to look to buy those. I need to pay for 72 cents at least. So right around here. So that one. So we've got a $8 wide, paying $6.50 here. So $6.61 divided by $8, 82%. So see how that it's not always going to work. And I actually found one, and I probably should have kept it. There was one that was like 92% the width of the strikes. Okay, and that, I mean, you're talking about paying $9.20 for a $10. You have the possibility of making 80 cents. Does anybody want to risk $9.20 to make 80 cents? Not me. Not me. All right. You guys have any other questions going on out there? I see some people are popping some stuff up. All right, I got that. Okay. No, I did that right. And GLD is a candidate. Yeah, GLD could be a candidate too if you're bullish on it for sure. Absolutely. Okay. All right, guys. That's about it. That's about all our time for the most part. This is our deal right here. It's how to trade options like the Wolfman. It goes from basic to more advanced stuff in here. Also how to protect. I can't explain. I mean, I was talking to somebody again, and I know I beat it in whenever I show this screen, protecting your portfolio against rising interest rates. This is the part of your portfolio, everybody's portfolio, that gets neglected. It's like the ugly stepchild or something like that. They're beating it with the ugly stick or something. And nobody looks at it. They're just like, oh, those things are fine. They're just going to sit there and trudge along. Well, at the end of the day, when interest rates are going up, that value of that bond portfolio is going down, and that's going to hurt. So It's a great way to stay active and mechanical with a rising interest rate market. Like, directionality there, so it's easy to trade it. I talk about how to do that. And all these other ones are really important to trading options. So you guys should really take advantage of it, especially for this discount. I mean, if you learned anything at all, I don't care how small a nugget I gave you, you're going to get a nugget of information that you are going to learn in each one of these. I can almost assure you of it. So for 36 bucks, it's huge. And to protect your bond portfolio, you guys will thank me in a couple of years for sure. But the best way to become a better trader is learning, and that's what you guys have obviously done. So I applaud you for that. I do the same thing. I still watch webinars and stuff like that, people talking about charting and stuff. I love that stuff. So I'm trying to constantly always learn too. So wouldn't you guys say that just creating an option strategy like the poor man's covered call, by going out online and reading about that, is not going to be enough to make you successful? You need to know these little insider tricks that professional traders are constantly using. And that's what I try and throw in there throughout these. So anyone can teach you how to build a strategy, but nobody is basically going to teach you how to set it up to increase your probabilities of success like I am. And I teach that, how to trade the probabilities. I mean, how many times did I say that before I started this whole ending here? Is when the probabilities have gone against us, how we stay mechanical and increase our probabilities even further in our favor. So take advantage of that. When you're using the right tools, you guys, you're going to be in the for the right situation. You're going to be more productive state of mind. You're going to be able to put on more strategies, create more opportunities, and ultimately you will be more confident as a trader and be able to sleep at night. And that's what I teach, is how to sleep at night, you guys, how to stay mechanical. You don't have to worry about it anymore. So we're offering this trial today for you guys. It is, somebody's already blowing me up with it. It's in the chat window. I'm sorry. How do you get this link? Well, if Wolfman's paying attention, it is going to be in the chat window in just a minute. Here's the thing. If you pause it, you have to type it into your URL. I don't have any hot links for it, but I'm going to copy and paste this over there right now for you guys. So there you go. It's in the chat window right now. So you can just click on that. Otherwise, like I said, if you're watching this on replay, you can pause it and just type this exactly into your URL. All right. But take advantage of that, especially if you're a newer trader too. I mean, but even if you're a technical trader, if you've been trading for as long as I have, you're probably still going to learn something here. Do you teach option strategies which are different, directional? Most income strategies are non-directional. I do teach directional option strategies, absolutely. And I teach when you should be buying those option strategies and when you should be selling those option strategies for your directional assumption, absolutely. I even have a chart that we give to our premium members that basically gives you a breakdown. Do I have high implied volatility? Yes. Do I have a directional assumption? Yes. And all of those things. Do I have earnings? And it will lead you to what the best strategies are for that particular environment and or your directional assumption. Very long-winded answer to your question, Chara. All right. So take advantage of that. Like I said, it's in that chat window. And one last thing, if I can find my thing again. Just want to thank you guys. Later webinars, we're going to be drilling down on different option components, trades, when and where I find them appropriate. I do that every day in my daily market commentaries, you guys. I talk about every single trade I put on, when I put them on, how much I paid for them, when I take them off, and how much I take them off for. Now, I do that in the morning usually, in the morning commentaries. I try and get all that stuff out early for you guys. And I want to thank you guys all for watching. You can reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. All right, got it all out of the way there. But seriously, take advantage of that offer we got for 36 bucks. You can't beat it. And if you guys aren't watching the daily market commentaries, do. I love all the feedback a lot of you guys have been giving me, so it's good. And if you guys have an option strategy you want me to cover that you haven't seen, reach out to us. But most important thing to do for yourself would be take advantage of this offer. All right. That's all I got for you guys. Other than if you can't take that, take it easy. Thanks so much, JQ. Appreciate it. Thanks, Andrew. Appreciate it. Moving to intermediate to advanced soon. Thanks, Shara. Thanks, Irene. Appreciate all your kind words, you guys. Take care. And sticking around after the close on a Friday. I always appreciate that. Bye-bye now.